What is a price oscillator? A price oscillator is a technical analysis tool that measures the difference between two moving averages, expressed as a percentage or in absolute points. To understand price oscillators, we first need to look at a price chart and two moving averages. The price oscillator uses two moving averages with different periods, typically a faster and a slower moving average. The price oscillator is calculated as the difference between these two moving averages, creating a new indicator that oscillates above and below zero. When the oscillator moves above zero, it indicates that the faster moving average is above the slower moving average, suggesting bullish momentum. Conversely, when the oscillator moves below zero, it suggests that the faster moving average is below the slower one, indicating bearish momentum. Traders use price oscillators to identify overbought and oversold conditions in the market. Price oscillators belong to the family of momentum indicators used by traders. Their primary purpose is to help identify potential trend reversals and gauge market momentum. They provide valuable trading signals, helping traders determine when a security is overbought or oversold, and offering potential entry and exit points. Price oscillators have several key applications in trading. They help traders analyze trends by showing momentum in the market. They provide entry signals when market conditions are favorable. And they help traders identify optimal exit points to take profits or minimize losses. In summary, price oscillators are versatile technical indicators that measure the relationship between two moving averages, helping traders make more informed market decisions. There are two main types of price oscillators, each with distinct characteristics. These are the percentage price oscillator, or PPO, and the absolute price oscillator, or APO. The percentage price oscillator, or PPO, expresses the difference between two moving averages as a percentage. It's calculated by taking the difference between a fast and slow exponential moving average, dividing by the slow EMA, and multiplying by 100. What makes the PPO particularly valuable is its ability to standardize oscillator readings across different securities, regardless of their price levels. The absolute price oscillator, or APO, shows the absolute difference in price points between two moving averages. The calculation is simply the fast EMA minus the slow EMA, with no further adjustment. Unlike the PPO, the APO values vary based on the security's price level, making it less suitable for comparing different securities. It's best used for analyzing a single security over time. Let's visualize both oscillators using two different securities. Security A has a higher price, while security B has a lower price. Looking first at the absolute price oscillator, notice how the scale differs significantly between the two securities due to their different price levels. Now for the percentage price oscillator. Notice how the PPO scales are more comparable between the two securities, making pattern comparison more meaningful. Let's summarize the key differences between these two oscillators. The PPO is expressed as a percentage, making it ideal for comparing different securities and portfolio analysis. The APO is expressed in price units, with scales that vary with security price. It's better for single security analysis and provides more intuitive price movements. The choice between PPO and APO ultimately depends on your specific analytical needs. Let's explore how the price oscillator is calculated. There are two main types of price oscillators, the percentage price oscillator, or PPO, and the absolute price oscillator, or APO. The PPO formula takes the difference between short-term and long-term exponential moving averages, divides by the long-term EMA, and multiplies by 100 to express it as a percentage. The APO formula is simpler. It's just the difference between the short-term and long-term EMAs, showing the absolute price difference. Typically, traders use 12-day and 26-day exponential moving averages, though these periods can be customized. The oscillator itself is often smoothed with a 9-period EMA to create a signal line. Let's work through a real example to make this concrete. For the PPO, we take the difference between our EMAs, which is 2.70, divide by the long-term EMA of 102.80, and multiply by 100. This gives us a PPO value of 2.63%. The APO calculation is more straightforward. We simply subtract the long-term EMA from the short-term EMA, giving us 2.7. Visually, we can see how the oscillator represents the relationship between these two moving averages. The price oscillator measures the distance between these two EMAs. When the short-term EMA is above the long-term EMA, the oscillator is positive, indicating bullish momentum. Remember these key points about price oscillators. Whether you use PPO or APO depends on your preference for percentage or absolute price differences. Both provide valuable information about market momentum. Divergence signals provide powerful indications of potential trend reversals. Divergence occurs when price movement and oscillator movement trend in opposite directions. Bullish divergence occurs when price makes lower lows, but the oscillator makes higher lows. As we can see in this example, the price chart shows a downtrend with progressively lower lows. However, the oscillator is showing higher lows during the same period, creating a bullish divergence. This suggests that selling pressure is diminishing despite lower prices, potentially signaling an upcoming reversal to the upside. Bearish divergence occurs when price makes higher highs, but the oscillator makes lower highs. In this example, the price chart shows an uptrend with progressively higher highs, but the oscillator is showing lower highs during the same period, creating a bearish divergence. This suggests that buying momentum is weakening despite higher prices, potentially signaling an upcoming reversal to the downside. Here are key points to remember when identifying divergence signals with price oscillators. These simple visual patterns can help you quickly identify bullish and bearish divergence signals. Let's explore overbought and oversold conditions in price oscillators. In technical analysis, overbought conditions occur when price has risen too far, too fast, suggesting a potential reversal or correction ahead. Conversely, oversold conditions occur when price has fallen too far, too fast, indicating a possible recovery or bounce ahead. The price oscillator helps identify these conditions through its peaks and troughs. Traders typically identify overbought conditions when the oscillator reaches extreme positive values, and oversold conditions when it reaches extreme negative values. Let's observe a sample price chart and its corresponding oscillator readings. Here, we can see the price reaching a peak, with the oscillator showing an overbought condition. Notice how the price subsequently reverses and moves downward, confirming the overbought signal. Similarly, here we can identify an oversold condition when the price reaches a low point. The price then recovers and moves upward, validating the oversold signal. Let's look at a historical example from March 2020, when markets experienced extreme volatility. The S&P 500 experienced a sharp decline during the COVID-19 crisis. At the market bottom, the price oscillator reached an extreme oversold reading. What followed was a strong recovery in the market, validating the oversold signal from the oscillator. Let's summarize the key points about overbought and oversold conditions. First, extreme oscillator readings often precede price reversals, making them valuable predictive signals. However, overbought doesn't always mean immediate selling is required. Markets can remain overbought during strong uptrends. Similarly, oversold doesn't always signal immediate buying. Markets can remain oversold during persistent downtrends. It's best to combine oscillator signals with other indicators for confirmation before making trading decisions. Finally, always consider market context when interpreting these signals. Different market conditions may require different thresholds. Combining the price oscillator with other technical indicators can significantly improve your trading results. This approach provides several benefits: confirmation of signals, reduction of false signals, a more robust trading approach, and improved risk management. Our first powerful combination is the price oscillator with moving averages for trend confirmation. When price crosses above a moving average, we look for confirmation from the price oscillator. A positive reading on the price oscillator can confirm the uptrend signal from the moving average crossover. Here we can see a buy signal where the price crosses above the moving average, while the oscillator shows positive momentum. Our second powerful combination pairs the price oscillator with volume indicators. In a downtrend, we want to see confirmation from both the price oscillator and increasing volume. Increasing volume during a downtrend, combined with a negative price oscillator, reinforces the bearish signal. Notice here how all three indicators align: falling price, negative oscillator, and rising volume. This confluence creates a much stronger sell signal. Our third powerful combination is using the price oscillator with the relative strength index, or RSI. The RSI helps identify overbought and oversold conditions, while the price oscillator confirms momentum direction. The RSI ranges from 0 to 100, with readings above 70 considered overbought and below 30 considered oversold. A powerful buy signal occurs when the RSI recovers from oversold conditions, while the price oscillator turns positive, as we see here. Let's summarize the key points about combining the price oscillator with other indicators. The most important principle is to wait for confluence. When multiple indicators agree, your probability of success increases significantly.